Dear students, hopefully all of you are doing very well. I am Dr. Sharat Khandaka and I will discuss today with you the lecture called Mergers and Acquisitions. Before going to the lecture, we look at some of the learning objectives of the lecture. Now these are the mainly learning objectives. 1. Identify what is meant by a merger or acquisition. Number 2. Identify the sources of synergies that are most commonly given for acquiring a firm. 3. Define the term tender offer and discuss the premium typically paid over current share price. Number 4. Calculate the maximum premium that should be paid in a stock acquisition. Number 5. Review a valuation method under efficient markets. Number 6. Identify two methods commonly used to pay for the target and their tax accounting consequences. Number 7. Discuss the role of the board of directors and shareholders of the target and of the acquired firm. Number 8. Distinguish between a friendly and hostile takeover. And number 9. Review some defense strategies against takeovers. So let's look to the lecture. Now the background and historical trend of mergers and acquisition. So mergers and acquisition taken place in the market for corporate control. The acquirer, who is the bidder, the buyer of a firm. So a firm wants to buy another company. So the buyer of a firm called the acquirer, and target is the seller of the firm. So the mergers and acquisition is a very important activity in today's business practice, and globally the takeover market is highly active, averaging more than $1 trillion per year in transaction values. So you can understand this is a highly valuable and lucrative market. Mergers and acquisition activities are activities in a business strategy designed to expand business activities. So mergers and acquisition activities are basically included to expand business activities by a large firm. Mergers and acquisition activities attract attention because deals are often large in monetary terms. Deals often involve well-known companies, frequently touches upon emotive issues such as national pride, international mergers and acquisition, and loss of employment due to the post-acquisition rationalization. So mergers and acquisition is a very important activity. Mergers and acquisition activity is a business strategy designed to expand the activities of a business. So in the global stage, as we mentioned earlier, there are more than $1 trillion mergers and acquisitions are happening every year almost, and the mergers and acquisition activities attract attention because deals are often large in monetary terms. Deals are often involve well-known companies and frequently touches upon the emotional issues such as the national pride when it's happening at the time of international mergers and acquisition, and because mergers and acquisition can also create some job loss or unemployment due to the post-acquisition situation. So in this slide we'll see 15 largest mergers transactions since 1999, and if you can see that in this part the acquirer name here is the target name, the announcement date when it's been announced of the mergers and acquisition, announced value of this M&A, and how the payments are made. So we'll look first three. For example, Time Warner Company acquired historic TW Inc. in 2000, and the announced value of this M&A activity was $186.2 billion US. And how the payment has been made? It's made through the stock payment. So the second largest mergers and acquisitions since 1998 includes Vodafone Group Private Limited Company acquire Vodafone Holdings GmbH, which is a German company. The M&A announcement made on 11th, 14th, so it's basically 14th of November 1999, and the announcement value was $185 billion. And how it was paid? The payment made through the stock and debt. And Verizon Communication made an announcement of mergers and acquisition in 9th of February 2013, and the total the mergers and acquisition value was $130 billion, and it was paying through the cash and stock. So you can look at to the other industries which have done the mergers and acquisition, but the most important part is if you look at to the size of the announcement value. That is the important part. If you look, they're very big in size, and how the payments are made is payments are made through stock or stock and debt, and sometimes in cash as well. But that very limited time it's been paid by cash or cash and stock. So let's look some important factors on M&A activities. Acquisition. So that is the first one we'll be looking. Acquisitions is a firm can be acquired by another firm by purchasing voting shares of the target firm stock. So this is called the stock acquisition. So when a firm acquired by another firm by purchasing the voting shares of the target companies. So how it can be done? So let's look. An acquisition by one company of another in which the acquiring company buys the target company stock. So for example, company A and company B. Company A is targeting to buy company B. So company A purchase the acquiring company's stock. So company A purchase the measured stock of company B. So this is called the stock acquisition. So in this case, no stockholders vote required. Can deal directly with the stockholders even if the management is unfriendly. So sometimes it can happen that the management, they do not want to go for the acquisition, because of course the management know if this M&A activity has taken the place, the target company management might can lose the job. So the management will not be very interested in most of the cases, that another company will acquire the target company. So in that case, stock acquisition could be a good alternative. So the stock acquisition. Another way is called the asset acquisition. So asset acquisition is when acquirer another firm by acquiring most of all of the operating assets, including the goodwill. So acquire another company. So for example, in this case, company A acquired the asset of company B. Now, interestingly, in this case, the target firm may continue to exist as a legal entity, because though its asset has been acquired by another company, but because its name still exists, so it can still deal business with its own name in certain cases. However, it requires a vote by stockholders of the selling firm, and it usually involves transferring title of individual asset, which can be costly. So stock acquisition can be when it's acquiring by another company. So as I mentioned, that company A acquired the asset of company B. So this is the situation when the asset acquisition taking the place. All right. So what are the classification of M&A? Now there are basically three ways the M&A activity can take into place, which is called the horizontal mergers and acquisition, vertical mergers and acquisition, and the next one is called, and it's called the conglomerate acquisition. Now what is a horizontal acquisition? The horizontal acquisition is when both firms are in the same industry, and usual motivation is to achieve economic of scale through integration of activities or rationalization of production facilities. So for example, two companies are in the same industry. Say for example, GM Motors did do a horizontal merger with the Holden Australia. So this could be the horizontal merger because both are in the same industry. GM Motors Limited, they are producing the automobile industries or automobile goods the same way the Holden Australia. So this could be treated as the horizontal merger. The second is the vertical merger, which is the firms are in different stages of production process, derived from some international M&A at present, and the motivation behind this vertical merger includes varieties of scenario. Say for example, often involve the cost reduction through the integration activities. So for example, in different stage the company are actually they're doing the mergers together. For example, one could be the transportation company, another could be the automobile industry. Or for example, it can happen that a large distribution industry is merging with a marketing company or a retail company, because they're not exactly in the same industry, but somehow their production process help each other, and that's called the vertical merger. And the conglomerate merger includes firm diversify into unrelated business activities. Say for example, that Microsoft, they want to do the merger with an automobile industry, so they are completely into different industry. Now in this case the problem is it requires different managerial skill in each area, because Microsoft is it's classified as technological giant. They are the best or the top company in technological industry, whereas the automobile industry, say for example the Toyota, is in automobile. So to do the this merger, the Microsoft need different types of the managerial skill in each area in order to make sure there are synergies. So whenever the acquirer is going to purchase or going to purchase the target firm, they need to think about the acquisition premium. So in practice, the acquiring firm will need to pay acquisition premium over the current value to gain the control of the target. So what does it mean? So the acquirer need to pay the target firm the premium price. So for example, company A is trying to acquire company B, and the company B share price is say on $10 in the market, but the acquirer need to pay higher than this value. All right, so let's write it down in here. Say company A share plus say $15. Company B share price is say $10. And company A is acquiring company B. So B is the target company. So when the company A is acquiring company B, which is the target company, though their market price is $10, but they need to pay higher than that. Say for example, company A needs to pay $11 or $12, and that is called the acquisition premium. So this premium is the percentage difference between the acquisition price and the pre-merger price of the target firm. Research has found that the acquirer pay on average premium of 43% over the pre-merger price of the target firm. So it's a very high amount, so 43%, according to the US data. Now remember, the takeover have been good for shareholders of the target firm, but not always for those acquiring firms. Now what does it mean? So company A, which is acquiring company B, in our scenario, so let's mark it as red font. So company A is actually acquiring company B, and the target company is company B, and the share price A is offering to B is, say for example, $12. But actual price of company A is, actual price of company B is actually $10 in the market. So it is good for company B shareholders, because though the share price in the market is $10, but they're receiving $12. So the receiving is premium. So for example, in this case of $2 in this scenario, right? But it might not be good for the acquiring firm, because they're paying an extra amount more than the market price. So the shareholders of the acquirer might not be always happy. So what are the motivation of acquisition? So in efficient market, mergers and acquisitions should be only occur when two firms are worth more than the combined than the separate entities. So what does it mean? So the main idea of the mergers and acquisition is that 2 plus 2 equal to 5, or say 4 plus 4 equal to 9. Why? Because if 2 plus 2 equal to 4 in the mergers and acquisition, a company do not like to acquire another company, because there are no value. A company only would like to merge with another company, or company A would like to acquire company B only in their calculation, when, say for example, company A value is $1,000, company B value is $500, and when they merge in acquirer and acquirer, it should be at least $2,000 or $1,700. So synergy is when two companies merge together and they get the benefit out of it. So the concept of synergy is that the whole is worth more than the sum of the parts. Sum of the parts 2 plus 2 is 4, but it's actually 5. Large synergies are by far the most common justification that the bidder give for the premium they pay for the target. Now that's the main concept. So what are the motivation of the acquisitions? So synergies are usually fell into two categories. One is the cost reduction synergy, and another is the revenue enhancement synergy. So the cost reduction synergy is easier to achieve because generally it involves layout, some employee, and these two companies' production will remain the same, or probably it will grow more in the market and cost will be reduced. And the revenue enhanced synergy is, for example, because of the cost reduction and because of the mergers has been taken the place, or acquisition has been taken the place, then the revenue of the company has gone up. Now it's quite difficult sometimes. However, the cost reduction synergy is easy because two companies, say for example, in the horizontal in the horizontal merger, as I mentioned, it's the same types of industry, so they can use the existing technology to produce more. So the cost is going down. So that's for the cost reduction strategy. So the cost reduction strategy or the synergy includes the economy of scale, economic of scope, and the vertical integration. So economies of scale is basically when there's a large scale of the production is making because of the mergers and acquisition, and the company can produce a large scale of the production. It will help them also to reduce the cost. So the large scale of operation is always preferred in for the large corporation. Economies of scope is the saving large companies can realize that they come from combining the marketing and distribution of different types of related products. So different product can be marketed within the same advertising channel and also through the different distribution channels. So economic of scope can be achieved through the mergers. So this is called the cost reduction synergies, and the vertical integration refers to that the merger of two companies in the same industry that takes product required at the different stages of the production cycle. So for example, different production cycle but in the same industry, so it will give them a cost reduction synergy for the corporations. For example, the Apple computers makes both operating system and the hardware. So they're in two different industries. One is the Apple computer having the operating system, operating software system, and the hardware. So when the vertical integration has been taken the place, one is in the production of the software, one is in the production of the hardware. So there will be a vertical integration benefit, or which is the cost reduction synergies. So the revenue growth strategy includes the marketing gain through the acquisition. So the marketing gain can be done through the advertising, distribution networks. So the acquirer firm with the superior product with the limited distribution capability can use the target firm distribution channel, and they can also do the product mix. So different types of product can be mixed through the same distribution channel and network, which will give them the marketing gain. It can also give them the strategic benefit because they can have a different types of product, different types of marketing channel, and the gain from the two companies distribution and marketing channel and the product mix, that will give them strategic benefit in the market, and it will certainly give a market power of the newly emerged large company. So these are the revenue growth synergies. So what is the capital utilization and efficiency synergies? So a merger may reduce the required investment in working capital and fixed asset relative to two firms operating separately. So for example, company A and company B. Company A might need a working capital of $100. Company B might need working capital of $50. So the combined working capital is $150. But when this company will merge, the new company might need a working capital of $130. So which will be a capital utilization and efficiency synergies. And it can be very, very possible. So more generally, acquirers often argue that they can run the target organization more efficiently and effectively because of they have the strong, motivating and very experienced management. Quite often, the acquirer think the target company management might not be very good management for them, and that's why they are not running the company efficiently. So this way, so the surplus capital asset can be sold. That's what they think, that the target company surplus capital asset can be sold, and they can make the company more efficient. Unused debt capability can be deployed, so they can borrow more money from the market and feed up funds that can be used to pay high dividend and repurchase some of the shares. So these are the capital utilization and efficient synergies. So another synergy is called the earning growth synergies. So it is possible that the combined two companies with the result of the mergers and the EPS of the mergers of the newly merged entity might be higher than the previous two companies. Say for example, company A and company B, their EPS, so company A and company B. So when the company A and B create a firm called A and B, their combined EPS might be higher than their combined previous EPS. So we'll see an example in the next slide that will clear up some of our idea. All right, so what is called the earning growth in this case? So EPS growth example or earning growth example. For example, a highly dubious reason for the mergers and acquisition is the case for corporate riders whose strategy relies not on the synergy but the EPS growth. So the EPS growth is one of the main strategies in this case. For example, let's look at this example that acquirer, which is company A, offer a $1 for 1 share swap to shareholders of target B, so target T, and a premium of 33%. So company A, the net profit is say $20 million. Company T, the net profit is $15 million. So is offering to do the share swap with target T company. So target A, the number of share is 10 million. Target T, number of share is 5 million. So the combined AT&T value will be, for the net profit for AT&T will be 35 million. Number of shares for AT&T will be share company A is 10 million. Company T is 5 million. So AT&T will be 15 million. The same way, EPS for company A is $2. Company T is $3. And AT&T will be $2.36. How we do it? We'll do the calculation. PE ratio. So for example, okay, next one is the share price. The share price of company A is 40. Share price for company T is 30. And the newly formed AT&T will be 46.67. But how we calculate this one? That's interesting as well. Because we are thinking the market value of this A and T will be $700 million. That's what we're thinking. So for example, the market value of company A is 400. How we get the 400? 40 is the share price, multiply number of share is 10 million. So 10 multiplied 40 is 400. Target company is 5 million shares outstanding and number of shares. Share price is 30. So 5 multiplied by 30 is 15. So 400 plus 150 should be actually 550, but we are thinking the market value could be, say for example, 700 in this case. How we do the price and earning ratio? Price of the share is 40, earning is 2, so 40 divided by 2 is 20. Same way for target company T. The share price is 30, EPS is 3, so PE should be 10. But we are assuming that the PE should be 20 of AT&T. How we think that? Because we think the share price will be 46. So 46, the share price, the earning per share would be 2.33. So if you do the calculation, it would be 20. But the question is whether the share price is 46.67 or not. So we'll look into the next slide how we assume. So we have seen in the previous slide that two companies, AT&T, A is actually acquiring company T. So and we have seen as well that if you go back to the slide that the net profit for A is 20 million, T is 15 million, and AT&T 35 million, and their market value will be actually 400 million plus 150, which will be 550 million, but they're assuming that it will be much higher than that, so it's about 700 million. And based on this calculation, they have calculated that the share price will be 46.67 and the PE ratio will be 20. But what really happened actually? So in this slide we can see that the P paid by an acquirer, which is A, for the target's EPS is 40 divided by 3 is 13.33, is less than the acquired current PE ratio, which is 20. But they're hoping that the EPS of the combined entity will increase. Now, for example, if you look at the situation that previously, that actually, their combined the combined value of the company will be 550 if there is no synergies, but they're assuming that there will be synergy and the company value will be $700 million. And that's why the calculation of the share price, combined share price and combined PE ratio is higher than the actual one. Now here the example is assuming that the PE of A and T stayed at 20, but why does the T has a PE ratio of only 10 at present? Because company A is assuming that the T has potential value and it will increase, the value of the company will increase after the merger, and that's why they're thinking that the value of the company, both company A and T, will increase. Second is what should be the post takeover PE of A and T will be. So we have calculated before that the post merger PE would be about 20 as assumed, though actually it will be lesser. It will be about 15.7, which is shown in here, because actual value of the company will be 550, which includes 400 million plus 150 million from company T, which implies that the PE ratio for A and T would be 15.7, but they're assuming that it will be 20. Okay, so the next question is, can the writer keep fooling the market in this way? Well, yeah, they could be, but the reason is the main motivation of this merger, that they're thinking that there will be a synergy, and the synergy is the most important thing in this situation. So here we'll talk about the managerial motives to merger. Now there are basically two basic reasons for the managers to go for the merger or acquisition. Number one is the conflict of interest. So manager may prefer to run a large company due to the additional pay and prestige. So normally we'll find that the managers are really interested to run a company which is larger in size, because they think that will give them a higher value. Second is called the overconfident. So the overconfident is that they think that if the company is larger, so it will be easier for them to manage the company, and also they think that because the acquirer company is doing very well, so they're confident that they will create the value from the merger. So these are the two main reasons that motivates the manager for the merger. Alright, so the next part is the offer. So once the acquirer has completed the valuation process, it is in the position to make a tender offer. Now in the tender offer, they actually announce that they're going to purchase some of its shares. So a bidder can pay for the target with the cash or stock, or a combination of both. So generally we'll find that they issue the stock, that's called the stock acquisition, but it can be paid in cash as well. In a cash transaction, the bidder simply pays for the target, including any premium in cash. Now remember that the target company, when they know that this company, another company is trying to purchase the target company, then they will not sell their shares in the current market price. They'll be looking for some more premium. So in a stock swap transaction, the bidder pays for the target by issuing new stock and giving it to the target shareholder in exchange of the stock in the target. A stock swap merger is a positive NPV investment for the acquiring shareholders if the share price of the merged firm exceed the pre-merger price of the acquiring firm. However, how we are going to calculate all of this? So let's determine what will be the synergy created from the merger. So let's A be the pre-merger value of the acquirer, and T to be the pre-merger value of the target, and S is the synergy. So A is the pre-merger value of the acquirer company, T is the pre-merger value of the target company, S is the synergy. NA is the share outstanding before the merger for the acquirer, and X is the new share to be paid for the target. Alright, so how we'll determine that what will be the offer and how it will and what would be the maximum offer or exchange ratio for the target company and for the acquirer. So if you look at in here, T is the value, T is the target company's pre-merger value, A is the acquirer pre-merger value. That's the value we're going to put. Acquirer company pre-merger value, target company pre-merger value, plus the S is the synergy. And what will be the exchange ratio? The exchange ratio will be based on all this calculation is basically PT divided by PA, 1 plus S divided by T. Let's look at an example, and that will clear our idea. So this slide will talk about a working example. In June 2020, for example, Wichovia announced plans to acquire South Trust. At the time, Wichovia stock was trading for $42 per share, and South Trust stock was trading for $35 per share, implying a pre-merger value of the South Trust of approximately $12 billion. If the projected synergy were $2 billion, so we're talking about the synergy, what is the maximum exchange ratio Wichovia could offer in stock swap and still generate a positive NPV? If you look at it in here, it's giving the Wichovia's target company's price of the share, which is $42. Then the acquirer company's price per share has been given as well. $12 billion is basically the pre-merger value of the target company, and $2 billion is the synergy. So if you put every information in here, you will find the exchange ratio is 1.4. Alright, so if you go back to the calculation again, this slide again, you can see here the exchange ratio will be PT is the price of the target company shares, price of the acquired company share, 1 plus S is the synergy, T is the target company's the value, and we can do this calculation by this way. So when we talk about the mergers and acquisition, we need to also think about the tax and accounting implication as well. So what is the tax implication? So in most countries, how the acquirer pays for the target offers affect the taxes of both the target shareholders and combined firm. So if they pay in cash, of course there will be some taxation implication. So any cash received in full or the partial exchange for share will be liable to pay immediate taxes for the shareholders. However, there is a situation, or there are situations where there will be no tax will be paid. For example, it's called the tax-free acquisition, and generally where the acquirer pays for the takeover entirely by exchanging bidder stock for the target stock. Then the tax liability is deferred until the target shareholder actually sells the new share of bidder stock. So when it has been exchanged through the stock acquisition, so because they will be receiving the new stock, the target shareholder, unless they sell the stock in the market, because they're not receiving any cash, unless they're selling it into the market, there will be no tax implication. Accounting issues. the method of payment does not affect the combined firm financial statement. The combined firm must make up the value assigned to the target assets by allocating the purchase price to the target assets according to the fair market value. So there are some accounting implication, and those need to be clearly treated according to the fair market value. So what will be the cost of acquisition? So in this slide we look into the cost of acquisition. So the cost of the acquisition will be calculated based on this formula. So changes of the V is the value of the firm. This is equal to value of A and T minus, in bracket, value of A plus value of T. So the total value of the firm T is to the firm A, in bracket, V multiplied V to the power T. It should be this formula, and the NPV of the merger is therefore NPV is equal to the value of T minus the cost of firms A of cost of firm A of the acquisition. So let's look at an example, and that will clear your idea. Now here we talk about two firms, firm A and firm T. Firm A price per share is 20 and firm T is 15. Number of share is 600 for firm A and 400 for firm T. Total market value is $12,000 and $6,000. The incremental value of the acquisition is changes in V is estimated by firm A to be $2,800. Firm T board has indicated that it will agree to a sale at a price of $7,600 payable in cash or shares. So the merger premium would be $7,600 minus $6,000, $1,600. Should A acquire T? Should A pay cash or stock? First, we need to determine the NPV of acquisition. So if you go to the next slide, it will show us the calculation. So first of all, we calculate the value. We find the actual value of the firm, which is the target company, is $6,000, and the firm will create the value. That's what they said, that they create the value of 2,800. So 2,800 equal to $8,800. Therefore, the NPV of the cash acquisition is 8,800 minus 7,600 is $1,200. So value of the combined firm, which is V, A and T, is, we put according to the formula, is $12,000, which is the value of A, plus 8,800, where we got this number, we get it from here, and 7,600 is the price paid for that. So the value of A and T would be $13,200. So the expected post-merger price per share would be $13,200, which is this amount, divided by 600, which is the number of shares. So the firm will gain $2 per share, because previously the value of the company share was 20, now it's 22. So firm A has paid an acquisition premium of 26.7%. How did we calculate? Based on this number, 7,600 minus 6,000 divided by 6,000 multiplied by 100. This will calculate that acquisition premium is 26.7%. From T, shareholders receive $7,600 regardless of whether the synergies are realized or not, because that's what they're going to get. The actual value is 6,000, but they're receiving 1,600 and extra. That's the premium. Whether there will be synergy or not, they will receive that amount. For company A, the gain is 1,200. How we calculate that one? 2,800 is this. That's the calculate the synergy or the increased value of the combined firm, minus $1,600 is they need to pay extra from $6,000. So there will be $1,200 gain. So in this case, the value of the combined firm would be, by solving this formula, it would be $20,800 to the stock acquisition. So what will be the cost of the acquisition? Depending on the number of the shares given to the shareholders. To give $7,600 worth of share at the current share price of 20, firm A would require to pay 380 shares to target firm. The post-merger value would be 2,800 divided by 980 shares, which is 600 old shares plus 380 new shares. How we get the new share? We just calculated based on the share price and the amount they need to pay, so which is 380. So the share price will be actually $21.22. How we get it? As I mentioned you earlier, that this is the amount 20,800 divided by 980 shares. How we get the 980 shares? 600 shares for the existing 600 is the number of shares outstanding for firm A, and 380 shares is the new shares. So in fact, the total value of the consideration received by T shareholder is 380 shares, and the value will be this amount. They receive this amount, 8,065.3. The NPV is actually 734.7. How we get this number is, this is the amount, this is the combined value, and then how much they need to pay. So we can see there is a positive NPV for the stock acquisition in this way. So the firm should go and and offer the stock swap for target company T. However, there is a question, or there is always a discussion whether the company need to pay cash or stock. Now we need to think about the different scenario, whether they should pay cash or stock. Now we need to consider the following situations. So considering when they're choosing stock or the cash, in a market and perceived to be overvalued, better to pay with shares. So when we're thinking that the market, the company is overvalued, it's always better to pay in shares. Why? Because if the market is overvalued for that company, even if you pay through the shares, the share price will drop in after that, so we are not going to miss any cash amount. However, when the valuation is almost accurate or very accurate, or our acquirer company management is very, very confident that they're paying the actual value and they're confident about the synergy, in that case they can pay through the cash. However, remember, as we mentioned earlier, the cash acquisition are taxable, and also sometimes if they're paying through the cash, they might need to think of some debt issue, because they might need to raise some debt, which might not be a good idea for them. However, we need to understand that when we're thinking about the control of the company, if we're thinking about the stock acquisition will dilute the company control, whereas the cash acquisition will not dilute the company of the control. So the current existing shareholder of the acquirer company, they will fully control the new target company. However, that whenever there is a cash acquisition or the stock acquisition, whatever it is, the board and the shareholders approval is always needed. There are different ways the takeover will take the place. For example, the friendly takeover, when the target board of director support the merger. So for example, A is acquiring T, and T, the board of director of T is happy with this merger. So that's called the friendly takeover. So the negotiation with the potential acquirer and they agrees on the price that is ultimately put to a shareholders vote. That's a friendly takeover. Hostile takeover. Hostile takeover is a situation in which an individual or organization purchases a large fraction of target corporation stock, and in doing so gets enough vote to replace the target board of directors and the CEO. Now, why a hostile takeover will take the place? Normally, when the friendly takeover is not possible, and the company's, the target company's board of director, shareholder, they're not very happy with the takeover bid, then the acquirer need to go for the hostile takeover. And the corporate riders are the acquirer in the hostile takeovers. However, there are different types of mechanism to protect or defense against the takeover. The number one is the proxy fight. So proxy fight is in hostile takeover, the acquirer attempt to convince the target shareholders to unseat the target board by using their proxy vote to support the acquirer's candidate for election to the target board. So the proxy fight is basically that when at the time of the electing the board of director, so the hostile takeover, they might can put either their own board of director for the election, and then they can fight against the nominated board of director by the board. The same way can happen by the board as well. So the board might can say that all right, they do not want to support the hostile takeover, and they can ask the shareholder to support the proxy fight, and they can introduce their own board of director for the election. Now this is a very good defense mechanism against the takeover defense. Poison pill is the second mechanism or the defense for the takeover. So a defense against a hostile takeover is a right offering that gives the target shareholders the right to buy the shares in either a target at a deeply discounted price. What does it mean? So the target company might can issue the rights to the existing shareholder in deeply discounted price. So deeply discounted price. So existing shareholder can buy some additional share with very below than the market price. So this will make the takeover very difficult for the acquirer, because there will be some additional new shares in the market. The share price will be diluting in the market, and then there will be some and the control will be difficult for the acquirer. So this will make the takeover to a next level, and it will be complicated. The third defense mechanism is called the staggered board. So in many public companies, a board of directors whose 3 year terms are staggered, so that the only 1/3 of the directors are up for the election each year. So a bidder candidate would have to win a proxy fight 2 years in a row before the bidders had the majority presence on the target board. So staggered board could be a strong defense mechanism. Fourth is the white knife. The white knife is when the target company is looking for another company for instead of the hostile takeover attempt. So they're looking for another friendlier company that can actually acquire the target company. The same way like the white knife, white square is also a defense mechanism. Investor or a firm who agrees to purchase a substantial block of shares of the target company, and they can have some special voting right. For example, each share might have 2 or 3 voting rights. Recapitalization is the way actually it could actually work very well against the takeover. For example, the company might can issue some more debt in the market, and that will be difficult, and that will make the whole takeover process delayed for the acquirer, because when the new debt will be issued in the market, the company will raise some fund, and the creditor will have a voice, and the acquirer might not be interested to purchase a company who has a substantial number of the creditors. So that could be another defense. Golden parachute is another mechanism for the takeover defense. The golden parachute is when a large payment or another financial compensation guaranteed to a company executive, should the executive be dismissed as a result of the merger's takeover. So at the time of the merger and acquisition, the board might can lose the job, and then sometimes they can they ask to get a large payment compensation package by the board or the executive management, and that need to be paid. This is another takeover defense. However, remember that any takeover or the mergers must be approved by the regulator in the United States. All mergers above a certain size, and approximately that is about $60 million, must be approved by the government before the proposed takeover occurs. In the European Union, it has a similar situation. In Australia, for example, 4 large banks, they cannot merge with each other or do a similar practice. So every mergers must be approved by the regulators in the respective countries. However, there is always a question that why do acquirers choose to pay so large a premium? And most likely explanation for that, there is an active mergers market is available in the world, and sometimes the company would like to play the monopoly in the market, and that's why they want to buy their own competitors. And sometimes we can see the acquirer start bidding on a target company, and it became clear that the significant gain exists. So there could be significant gain exist in the market. That's why the acquirer is very interested to acquire a target firm. And sometimes the takeover process or the acquisition process can be it's a very big news matter when 2 large companies merge or 1 big company acquire another company. So it takes significant attention in the world. So the next slide is about the free rider problem. Often a target firm is poorly managed and resulting a low share price, and that is the main motive for an acquirer to acquire a target company. For example, assume the current market price of a target company is $45, and the acquirer thinks the potential price it could be $75. If the corporate rider makes the tender offer of $60 per share, tendering shares gain $15 per share because the market price is $45, and when they're offering tender of $60, the existing shareholder will receive $15 extra, and they'll be very happy to pay. However, there will be some free riders. They assume that the price is not actually $60, but it's $75, which is this amount, and they will not do anything. They will wait, and that way, they will be actually receiving $75 after the company has been acquired by the next company or the acquirer. Hopefully you liked today's lecture. Thank you very much for watching my video, and if you like it, please subscribe to my channel. Thank you.